When you look at our 2015 half-year results, I think there's three key areas that people are focusing on. Obviously the numbers and the operating results, which are all going in the right direction, the Friends integration, and of course where we're at with Solvency II. Well, the results today show some real tangible progress, and you're seeing it through all the key indicators. So you're seeing operating profit up 9%. You're seeing our best core, that's the combined ratio on the general insurance, for 8 years. You are seeing value of new business, which is the key measure of sales and growth, that's up 25%. Now that's at the time we've had the integration going on at the same time, so that's quite an adequate result. What you're seeing is, I think, the benefits in the Aviva of real diversification. We've got geographic diversification, we've got product diversification, and you don't expect all countries or all business lines to perform well at the same time. The dividend, of course, is something that the investors really do focus on, and rightly so. And we increased the dividend last year by 20, and what you've seen in the first half of this year, the interim dividend is up 15%. That should give investors and our shareholders a good degree of confidence in our future and our cash flow. If you look at Aviva 3 years ago, it was a fundamentally different proposition. The company had real issues and real challenges. We had a balance sheet that was fundamentally broken. We had relationships with regulators around the world that were strained. Staff morale was extraordinarily low, and we really didn't have any plans to go in the future. But as a business, we also had a number of really important advantages. We had a huge customer base that really can be a source of growth for the future. We have a brand that's probably unparalleled in the financial services world, and we had technical expertise inside the company that I've never seen before to that level of depth. So we had a lot of strengths as well. Now, if you have a look now, we are in a different place, albeit still with much more to do. We've ticked off a lot of the big issues that really everyone thought were unfixable. The Friends Life acquisition is really fundamental in our transformation of Aviva. It really ticked off some of the outstanding issues that really would have taken us probably another 3 years to do. It added a lot of liquidity, it added capital, and it added strength in some product areas like large corporate pension schemes that we just didn't have before. It just gives us more strength as an overall group. A lot of commentators were suggesting that there'd be a lot of distraction with the Friends Life integration, and of course it is a major project that's taking a lot of resource. But what we've seen is that the UK life business, in terms of their sales results as measured by B&B, has been a very satisfactory outcome. The total UK life sales are up 43%. So that's a pretty adequate outcome and strong growth in a market that has a lot of potential for us. I've been asked a lot, well, how's the integration going? This is really our first big update to the market. Well, let's look at a few things. So first of all, we have the cost synergies. That's £63 million after 3 months. That certainly is ahead of expectations in terms of the schedule for getting it done. Another key part of the Friends Life integration is, of course, moving the assets from external fund managers to our internal Aviva investors. So far this year, we've brought in £22 billion direct from the Friends Life into Aviva investors, and we've served notice on other fund managers such as AXA to bring in a further £24 billion. For the last 3 years as a group, Aviva's been very consistent in what we're trying to do for shareholders. Our investment thesis is predicated on cash flow plus growth, and that hasn't changed at all. In fact, the Friends Life acquisition helps that investment thesis a lot. So turning to the life business line results. Globally, we've seen a 25% increase in value of new business. That's despite the annuities and the pension changes in the UK, and it really shows the benefits of having diversity across our product range. Within that, you have some highlights of the UK, which was a very strong performer. Italy was up 66%. Asia was also strong at 18%. Ireland also contributed as well to that. So you've seen a breadth of performance across the life businesses. Of note also is the product mix has changed. As a group, we're now much less reliant on annuities. That was a strategic decision we took in fact, before the changes in UK pensions and annuities last year. So that mix shows strength in the group, and you've seen the highly profitable protection business go up over the same period. General insurance has been a work in progress now for us for a couple of years. For about 6 years, we've been declining in terms of our premium coming in. And although we don't target top-line growth, I'm more interested certainly in underwriting profits. It's nice to see that with our product strategy, we are now growing premium again. Morris and the team have looked at their product, they've improved the analytics, they've improved the underwriting around the group and changed their product mix as well. Also, we've seen the benefits of quite benign weather in the first half, which has boosted our results. But the result of all of those things is that we've had the best combined ratio, the best core, for over 8 years. One of the things that we've just announced is an exclusive deal with TSB in the UK. That's a pretty good indication, I think, of where we're going. And moving to asset management. I've said for quite some time, asset management is a work in progress. It will take longer to get the fund flows in than the turnaround in the other life and general insurance businesses. And to do that, you need a hero product. You need a series of products that really make people stand up and look at what we're doing in that asset management business. For us, that product is AIMS, Aviva Investors Multi-Strategy. Now, it's been going for about 12 months, and that first 12 months, it has outperformed its peers. So it's done exactly what we wanted it to. We've had a lot of interest in it. It already has £1.7 billion of assets in those funds. In terms of the rest of asset management, we also have a number of customer-focused platforms. It's all very easy to look at our results and look at the metrics going the right way and think everything's going well. And at the high level, that may be true. But it's not all good. There's still a number of areas in the group that I think we're quite unhappy with the performance. I think although we've made some progress on expenses, particularly in the Friends Life integration, the expense reductions in the first half, in my view, could have been better. I think some parts of Europe did not perform as well as they have in the last 2 years, albeit they've had a couple of very good years and there was a lot of headwinds from currency. Solvency II has been one of those projects that seems like it's been never ending. In fact, as a group, we've spent around about £400 million and an extraordinary amount of management time, and that is a figure that we are not very proud of. It's entirely unacceptable. Nevertheless, the hard work on Solvency II and getting ready for it is just about done. What I call the envelope of uncertainty for where we'll come out has reduced a lot and reduces each week as each week passes. And we've already submitted our model now to the PRA for approval. We would fully expect to get that model approved in December, and I think I'm pretty happy about where we are. We also need to consider that the group is in a fundamentally different position with its balance sheet than it was just a few short years ago. Our debt ratios on an S&P basis is down to 27%, well within our range. Our group central liquidity is at £1.6 billion. That's versus £200 million just a few short years ago. Our internal loan balance is now sitting at £2.7 billion versus £5.8 billion just a few years ago, and it's right on track to get to £2.2 billion, which is our target for the end of the year. So as a group, Aviva's now moving to a different phase of its turnaround. We're really done with the fix part of it, and now we're moving much more into the transform and grow phase of our turnaround. Our strategic anchor, of course, is about being a true customer composite, digital first, and operating in a certain number of markets. Now, Aviva has this strategic competitive advantage built in for the fact that we have so many customers and that we're a composite insurer. And in a digital world, to be successful, in my view, you must be a composite insurer. Customers want simplicity, they want convenience, and we can provide all that to them. Now, we've separated out all of our digital businesses. We've put them under a separate company with a separate board, and that's headed by Chris and Andrew and the team. And they're making some real progress in terms of those customer propositions. And my objective here is to increase our products per customer from a paltry 1.7 products per customer at the moment to over 3. We've got our digital garage in Hoxton Square, which is in the middle of Shoreditch, which is the fintech hub in the UK. And in Singapore as well, we're starting up another digital garage there, and that really looks an exciting initiative. So the digital and direct businesses now have over £1 billion of revenue in them. But it's not just about revenue, it's also about the cost base you put there. So we've taken £100 million out of the rest of the business, that's per annum, and we've reallocated that to digital. There is a global insurance revolution going on, and it's called digital, and Aviva wants to lead that revolution. So where are we now? Am I happy with the results? Well, of course I'm not. But I am happy that we're making some progress towards where we need to be. I think our strategy is clear with our strategic anchor. I think our investment thesis of cash flow and growth is equally clear. I think our people in our team, we've got the right people in our team to deliver what we're saying. I think we've made some tangible progress towards the Friends Life integration and Solvency II, so that's two big issues that I think we're making good progress on. And so I think we're pretty confident about where we're going. But what we've got to do is keep delivering, and we've got to keep delivering at a pace that I'm comfortable with. And I'm not really known for my patience.